Welcome everyone to my quarterly update for the period ended 31 December 2020. I'm going to take you through returns for the quarter, the year and 3 years, and then I'm going to talk to you about why the share market is not the economy. The December quarter was busy. We had our own election late in October when Labor had a landslide victory to become the first majority MMP government, although they did drag the Greens along. We also, eventually, had a decisive election in the United States where the 46th President, Joe Biden, was elected over a protesting Donald Trump. We finally had Brexit on literally the last day of the year, 31 December 2020. And of course, we had the final phase of trials on 3 leading vaccines for COVID-19, AstraZeneca, Pfizer and Moderna. Overall, there are 67 active human trials in late stages for different vaccines, with 20 in the very last stage. There are also lots of vaccines from Russia and China, but we don't hear too much about those. This slide shows the growth of $1 invested for the last 3 months of 2020. $1 invested in international small companies in October last year would have grown to $1.14 by the end of the year. In second place, we have Australian shares where $1 invested would have grown to $1.12. In third place, at $1.07, is a 50-50 mix of cash and fixed interest and shares and property. A pretty good result. The worst performer was the S&P NZX A-grade corporate bond index, where $1 invested at the start of the quarter would have turned into 99 cents at the end of the quarter. The reason for that is that interest rates actually increased during the December quarter. But what about the year? The March 2020 quarter still had a big impact, but overall, 2020 looks pretty good. Almost every asset class is up for the full 12 months. The leader this time is New Zealand shares, which would have grown to almost $1.15. In second place, jointly, are international companies hedged to the New Zealand dollar and emerging market shares, which would have grown to $1.11. $1 invested in that 50-50 mix of cash and fixed interest and shares and property would have grown to around about $1.04. That's not bad, given that large dip in March. The only one laggard is international value companies, which were still a little bit below their original dollar at around about 93 cents. A bit to go. I always say 1 year is interesting, but 3 years gives us some actual data. This slide shows the same asset classes over 3 years. This time, every asset class is back above that dollar. That March quarter still looks pretty material, and it was, but over the 3 years, much less so. Leading again is New Zealand shares. This time, over 3 years, that $1 would have grown to almost $1.60. In second place is international shares hedged to the New Zealand dollar, which would have grown to $1.31. In third place is international small companies, which would have grown to around about $1.25. This time, in fourth place, is that 50-50 mix of cash and fixed interest and shares and property, which would have grown to around about $1.21. By the way, that's actually the long-run expected return of that kind of mix of assets. Notwithstanding a great big COVID crash, that's actually a pretty good 3 years. Somewhat unexpected. On to the economy. Spoiler, it doesn't look good. This is the International Monetary Fund's forecast for economic growth for 2020. And there isn't much. In fact, there isn't any. All of these economies, all of these regions are expecting negative economic growth. Doesn't look great at all. What about share markets though? Not every share market had a positive year, but almost no share market had as negative a year as those forecasts for growth. In fact, the S&P 500, the main share index in the United States, closed at a record high at the end of 2020. That's despite the fact that the US was actually the worst economic performer last year. It returned 16% for the last 12 months, ended 31 December 2020. The New Zealand share market, despite a negative growth year, returned 15% for the year. Well, that's surprising. Intuitively, surely, we would expect that there would be a relationship between economic performance and market performance. This quote was shared with me recently from Henry Louis Mencken, as an American satirist, journalist and writer, about the nature of simplicity and how, as much as we'd like it to be, most things aren't. It is entirely natural, intuitive and simple to expect that share market performance will be explained by economic performance. It's nice, it's simple, it's concise, and it's wrong. Share market performance is not explained by economic performance. Anyone who invested based on economic forecast would have sold their investments last year and would still be waiting for economic indicators to pick up before getting back into the market. They would have missed a very good year. We hope that's not any of you. Happily enough, it's none of our clients. I hope you've enjoyed this market update, and I look forward to updating you at the end of next quarter.